everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings so you don't have to. Today we are diving into a Form 8K from Momentus Inc. Now the name might sound like a fitness app, but trust me, their business is way more out there. We are talking space travel literally. Let's see what kind of deals they've been making. So Momentus filed this report because they made a deal with a warrant holder. Now, warrants are basically like options to buy stock at a certain price. This particular holder had existing warrants that allowed them to buy Momentus stock. The holder agreed to use those existing warrants and buy over 1 million shares of Momentus stock for 1.93 a share. That price was the same as what the stock was trading for that day. Think of it as using a coupon to buy something that's already on sale. Now, why would Momentus want someone to use their warrants? Well, to convince the holder to do it, Momentus offered them something extra, inducement warrants. These new warrants would let the holder buy even more stock, up to twice the number of shares they just bought with the existing warrants. It is like a buy one get two free kind of situation. The deal went through, meaning the holder bought the shares and Momentus issued the new warrants. This is good, they just traded some of their options to buy stock for real money. If you want to read the whole inducement agreement, you can find it on the original 8K filing. This part is important because it explains that Momentus didn't register these new warrants with the Securities and Exchange Commission. It means they didn't go through all the usual steps to offer these warrants to the general public. Instead, they relied on some exceptions that allow them to sell securities to certain qualified investors without registering. These exceptions, called Section 4A, 2, and Rule 506XC, are for situations where the company is selling to people who are considered accredited investors. Basically wealthy people or institutions who are supposed to be sophisticated enough to understand the risks involved. So what's the big picture here? Momentus needed some cash and they convinced a warrant holder to exercise their warrants early by offering them even more warrants. They did this without registering the new warrants with the SEC, relying on exemptions for sales to accredited investors. Arctus of credited investors off now. Let's take a step back and look at the bigger picture for Momentus. Momentus is in a risky industry. They're trying to build space infrastructure, which is expensive and technologically challenging. They face competition from established aerospace companies like SpaceX and Boeing, as well as other up-and-coming space startups. Their strategy seems to be focused on securing funding through these kinds of deals to stay afloat long enough to deliver. One notable risk is their reliance on these exemptions to sell securities. If they can't continue to attract accredited investors, they might have trouble raising the capital they need to fund their operations. However, there is also an opportunity. If Momentus can successfully develop its technology and capture a significant share of the space transportation market, the warrants might be worth a lot of money. Overall, Momentus is a high-risk, high-reward company. Their future depends on their ability to execute their business plan, navigate the regulatory landscape, and secure enough funding to reach their goals. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more Corporate Decoder videos.